Good afternoon. Welcome to our JPI 2025 Multifamily Market Outlook. Very excited to have everyone on today. We have investors, we have lenders, we have capital partners, both existing and then folks that we've been working with JPI for 3 decades, and then some new ones that we look forward to working with. So we all understand on this call, housing, it's not just a financial asset. It's a fundamental need in our community that shapes our community. So we're super excited and encouraged to talk about it. We're at a very interesting time in the multifamily space in general, and especially in the development space. As everyone on the call knows, we've come through a lot of supply, and there's still a lot of supply, but as Jay and Jill and myself will talk about, it's rapidly coming down. And so we think now is a very interesting time and a great time to focus on development, and specifically in this workforce attainable market that we will be talking more about. My name's Payton Mayes. For those of y'all who I haven't met, I have the privilege to lead JPI. Really glad that we have Jay Parsons on our team. Now, Jay is a well-known name in the multifamily rental space. Jay is also, we announced a few weeks ago that he is now joined JPI as our new economic advisor. And I think JPI, we're blessed to have really, really great people on the team. And Jay is another person that we're super excited to have because his insight knowledge is, I think, second to none in this industry. And then we're also super excited to have Jill Homan. Jill is a managing director with Pinnacle Partners, who JPI is partnering with on this workforce housing fund. And Jill is going to be digging into some insight of how do we actually choose the markets and some of the projects that we're going into. So with that, I'll just let Jay get started with the big picture. And how does the multifamily outlook in 2025, how does it compare to recent years, Jay?
First of all, thank you so much, Payton, for allowing me to be part of the team. And thank you for all of you for joining us today.
And while you're doing that, Jay, I want to remind people that you can ask, on my screen, it's the bottom of the screen, but wherever it is on your screen, you should have a Q&A thing somewhere. And you can ask anytime you have questions throughout the presentation, please put it in there, and then we will get to that at the end.
Absolutely. So where are we today? Let's start with that. You may have seen, I'm sure all of you are familiar with the headlines around multifamily. Obviously, we've seen lesser rent growth, and we've seen some challenges related to the current supply that Payton mentioned. But one thing I think it's really important to note is that there's not been a demand issue. We have a lot of demand for apartments. And in fact, when you look at how this last couple of years has played out, it's been a little bit of a roller coaster. But you can see that in this chart, the reemergence of demand, strong demand last year. In fact, I was probably among the more bullish people on demand last year, but even I was wrong. Like, it was more than I expected, and I think more than really anybody anticipated in terms of net absorption. And so you can see in 2021, we had this huge boom post-COVID or during COVID, then peak inflation, there's nervousness around the economy. We had a lot of jobs being formed, but people got a little nervous how people stay in place. And then 23 started to get better, and 24, a lot of supply, and then we saw a lot of demand really meeting that supply, which really told us that there was a lot of pent-up demand for apartments out in the marketplace. And by the way, too, when you think about this as well, I want to point out, a lot of times I show this chart here like, well, it's because no one's buying a house. And I'll get into that a little more later, but I'll tell you, when you look at, when you think about apartment demand, and for us, it's really net absorption, move-ins minus move-outs. These are net new renters. Most home buyers are already renters. Now they're going to go in to buy a house. And so this is just true. These are people who generally are in that apartment demographic, and now they're entering the apartment stage of life for the first time. So let's not give the stalled out home buyer market too much credit here. So again, really good demand. All signs that we've seen through the first part of 2025 is a pretty similar story. And then at the same time, the market now is a little bit different than the past few years. We've continued to see this flurry of starts. Now we're not. So this chart is showing, this is probably one of the more popular charts that I show on social media and whatnot. People are always asking for a copy of it, but happy to share it with you all too. Is publicly available data, but it's just showing you the difference between starts versus completions in multifamily. And so this is a really, I think, powerful visual to show you that in these last 12 months, as a country, we've completed 262,000 more units than we started. And that's the biggest gap since 1975. And so starts are plummeting. Current moment, there's a ton of completions in the market. Obviously, you don't need an advanced math degree to figure out where this is going, where we're going to ultimately see a lot fewer starts. And so that's a big shift as well, is that while we're dealing with a lot of lease-up challenges in the moment because of the influx of a 50-year high of supply, starts are really showing us within the next 12 to 24 months, there's going to be substantially less in terms of supply.
Jay, we started the webinar with how we think now is an interesting time to invest. I'm curious to hear your perspective. If we believe that, then we think that's true. Why graph go down look like a knife? Why aren't people and other developers? There's a lot of great developers in the marketplace. Why don't they start projects?
Well, I mean, Payton certainly is, as you know, I mean, everyone's trying, right? But this is a market where it separates, those who are able to execute versus, those who can't. And I think that's the real difference. I mean, everybody's kind of showing similar things right now, but I think it's about having the right strategy and the ability to execute on that strategy to really make things happen at this point. The perception among investors out there today is that oftentimes it can be easier or cheaper to buy than to build. But I think we're getting to a point where the market's starting to realize that, that's maybe true in theory, but it's hard to do in reality, particularly at scale. And so, I was talking to big brokerage groups recently, and they were sharing that they're seeing more capital is interested in investment in development again, just because of the challenges of buying in any scale in this market, given the lack of supply in the market. And then also too, just kind of advancing forward here, as you look at where this is going in terms of supply, again, supply has been the biggest headwind. It's not been a demand issue, it's been supply. We're peaking on supply now, but you look at this forecast, I mean, this is really the bull case for development, which is showing you that by next year, we'll have fewer than 300,000 units completing in terms of apartments across the country. And that continues to decline in 2027. And so when you think about projects that start this year, they're completing 18, 24 months later. So at this point, you're probably looking at 2027. That's a low supplied environment at that point. And I like to remind people too, it's like, forecasting is a tough business, right? Like no one can predict the future, but supply is the easiest variable to forecast because it just starts being pushed forward. And as we showed you earlier, there's a lot fewer starts in the market right now. So I think that creates a real opportunity for those who are able to build because you're going to be dealing with a lot less lease-up competition at that point. And by the way, one other thing I want to share too, kind of on the bull case here, for really all types of development, but I think this is important for workforce housing too, is that, over these last 18 months, we've seen very little rent growth in the market. That's that blue line. But there's also, I think, a really encouraging narrative that's not getting enough discussion right now. And that's that we've seen more than 2 straight years of more wage growth than rent growth. And while obviously for apartment investors, seeing no rent growth for 18 months is not an ideal equation. A couple of things though. Number one, we had a 50-year high in supply, and the fact that nationally rents held flat, didn't get cut deeper than they did. And even individual market level, most individual markets like in DFW, for instance, were low single-digit rent cuts. That just speaks to the depth of demand. Now, the other part too of that is we've seen, again, 26 straight months of wages growing faster than rents. What that's doing is it's widening the demand funnel for apartments in terms of who can afford apartments. And that impacts all price points as well. And so it's a win for renters and a win for investors and developers to see that demand funnel widened. And so again, going forward, lesser supply, that should put upward pressure on rents. But we've had this period where we've essentially wiped out the blue hump here where rents grew faster than wages in 21 and first part of 2022. And that's going to put us in better position on for affordability as we get into 26 and 27, where with market rate renters paying 22, 23% of income on rent and that number going down, that will allow for affordability to more of a tailwind than a headwind over these next few years.
Great. Thanks, Jay. One thing that you hit on, and, supply is falling off like a cliff, and there's a lot of developers that would like to get projects started, but they've struggled. One of the things that I'm super proud of at JPI is how we have an integrated team. So JPI has been in the market 35 years and developed $26 billion, 118,000 units, I think 380 some odd communities, and lots of lessons learned over that time period. With our integrated team, I feel like the stronger developers, and there's a lot of great developers out there, but the stronger developers with integrated construction teams tend to outperform in markets like this. And you saw that during the GFC on the single family side, during the great financial crisis, the D.R. Hortons, the Lennars, Pulte's, et cetera, they grew market share. While it was, a more difficult time for everyone, they tended to thrive. And so I'm super proud of the fact that we do have the integrated team here at JPI. And with that, Jill, maybe I'll kind of ask you about we've been working with you for a while, Pinnacle, and hand in glove on figuring out where for this new workforce housing fund. What are the projects and the markets that we want to offer to our investors? And maybe turn over to you to talk more about that and more about our data-driven approach.
Yeah, and thanks so much, Jay, for really the thoughtful analysis. And I think it's, you're really putting numbers to, I think, what a lot of us have been hearing and feeling anecdotally in the markets where, we're investing and building. And so thank you, Payton. We're really thrilled and honored to join with JPI on this workforce housing fund. And in collaboration with JPI, we really looked at the pipeline of projects that are truly workforce, and that's something that we'll talk more about, and also projects that are ready to go and buildable and in markets that are target markets. And so we focused in two projects in the Dallas market, Denton and McKinney, and also Oceanside, California, which is northern San Diego, and Redmond, which is Bellevue, Redmond, Seattle markets. And so I'll start at the north and go south. And so just, when we look at the Redmond market, it doesn't really take a rocket scientist, or maybe it does take a rocket scientist to talk about that. And it's really a story of technology. When you go to particularly the Redmond market, it is where Microsoft has its headquarters. And so it's a market, and it's a story of technology, jobs, return to work. In this particular location, interesting, you also have, in addition to having a massive Microsoft campus, you do have a light rail system. And so that can provide transit options as well for folks. With that market, it's also has realized significant trades. So there's been some very significant trades of multifamily portfolios. And so, with these markets, while one could say, Redmond is, a submarket within a greater Seattle submarket. It's a very institutional liquid market right next to the Microsoft campus, would be serving the tech workers and then also the other businesses serving the technology workers, in addition to having these transportation options. You have very strong wage growth, yet it's chronically undersupplied. It's a market, Washington and California. So these are markets where going through the zoning and regulatory process, and I'm sure Jay has a chart somewhere in the repertoire there, when markets that are just hard to build, once you pick that lock, you've really unlocked and created a ton of value for the projects. One of the reasons is JPI has a strong presence and knowledge in that market, with the chief investment officer at JPI, and Pinnacle is actually based out of Seattle. And so we have a strong presence there and know that market very well. And it has also a high growth potential, and also the story as well of drop-offs in new construction starts, and leading to what we expect to be some strong rent growth. I'm going to head a little bit to the south and talk about Oceanside, California, and also reference that as part of the San Diego market. And when I describe Oceanside, and maybe nobody has described San Diego this way, but it reminds me a bit of being from Washington, D.C. We'd always describe our market as eds, meds, and defense. So you have universities there within that market. You have very strong pharmaceutical and research employment, and then you have Camp Pendleton. And so it's just a military base that really benefits. And as a result, there's been a housing shortage and also significant housing needs in this market. And so it's a hub. In addition to those strong employment factors, particularly Oceanside, you're a mile and a half from the beach. And so that's a really strong. So you're balancing the job and employment growth with the high quality of life. And then by moving up to the Oceanside, California area, you're really looking more towards that workforce and more of a rent that is an approachable rent for folks in these industries. I'm going to head a little bit further then to the south to California to Texas to talk a bit about these two markets. So Denton, McKinney, and more broadly, the Dallas market. And what I'd maybe just kind of offer this is, if you remember nothing else, I've read recently as I was reading research reports and looking at data underlying our conclusions, and that is the Dallas-Fort Worth market has added the most jobs relative to any other MSA, with 450,000 jobs. So this is, post-pandemic. So it's just a very, very strong demand for jobs. And I've heard it described as really the demand is following the supply in these markets. The construction activity in Dallas broadly is expected to hit a 10-year low in 2025. And so as new supply is coming online, the analysis is leading to conclusions that vacancies should tighten and rents should increase as well. And that's also evidence within, it's pointing out the conclusions that Jay was making, which is, new construction starts are half of what has been delivered. So if you look at what's starting over the last 12 months, it's half of what has been delivered over the previous 12 months. So it's just there's a significant drop off in construction. And so it looks like that 2025 was the peak for the market, and they're expecting a sharp decline and hitting to a low in 2026, which were, with two projects in these northern Dallas suburbs, we're very excited about what the market outlook is for new construction. And this is a market that has historically had net absorption of 20,000 a unit per year, in that kind of pre-pandemic 2015 to 2019. But now on the market has had net absorption of 28,000 a year. So it's just a story again of corporate relocations, of job growth. And so when we look at the Denton market and also the McKinney market, again, it's a story of job growth and corporate relocations, and then also the population following the supply of housing. So I'll kind of pause there. I've talked a lot about these different markets and maybe hand it back over to you, Payton. But really, we love markets that are high barrier to entries, and that's particularly why we were focused on Washington and California, where we really understood the Redmond market and the story. California, it's very difficult. I'm sure Payton has battle scars over going through the zoning process of California. And then in Dallas, it's really a story about the tremendous job growth and the dramatic drop off in construction starts, which we're excited to have projects that can deliver into a market that is going to become supply constrained.
Thanks, Jill. Yeah, you mentioned the barriers to entry, and obviously the Dallas-Fort Worth market is a different market than Redmond and Oceanside. But one thing I'll say is that JPI, we've been the largest developer in DFW, multifamily developer for I believe the past 8 years, as recognized by RealPage. Our model here, there obviously are lower barriers to entry here, but we have a land chase meeting, a land acquisition meeting every Monday morning at 8:30. And during that, our team looks at roughly 600 land sites a year. And it's a funnel process to figure out, which ones do we believe are the best risk-adjusted returns. And again, it's a very data-driven approach. And even though Dallas-Fort Worth, compared to, California and Washington, has lower barriers to entry, there are barriers to entry of I think the amount of institutional knowledge that JPI has in developing in these markets, and both of these assets in Denton and McKinney we're public-private partnership with the governmental entity to provide some more affordability in return for some real estate tax help. And those relationships they take a while to develop and build. And so we're super excited about all of these assets. And so one of the questions we got, and I think, Jay, some of the slides that you have kind of speak to this is, what is workforce housing? and how do we define workforce housing, where there's that missing middle. And so maybe Jay, if you could spend a few minutes giving your perspective on workforce housing and kind of how we're trying to attack that.
Yeah, absolutely. I have a slide here that's focused on Texas, but we can do similar things for other states across the country. And I think and first of all, just to acknowledge, I mean, when you look at what defines middle income housing, I mean, in certain programs and whatnot, it's going to be based on the area median income of a certain neighborhood, census tract. So this is a little bit of a generalization, but it does give you a picture of the story here, which is on the left side of the screen. These are people who would qualify for traditional low-income housing, which typically are people who are going to make 60% or less, or less than 80% of the area median income. And then on the far right, a lot of people don't realize this. I think even people in the industry, it's like if you're going to be renting a brand new market rate apartment, even in a place like Texas, you're typically talking about a household income north of $100,000. Now, bear in mind, when we say household, that could be two roommates out of college, making $60,000 each. But together, that's a six-figure income household. And then in the middle, you have folks who are too rich for quote unquote affordable housing and too poor for brand new market rate housing. And so this is the missing middle. And so, while they do have older properties that kind of age into this, you also have properties that get value added up and they're no longer affordable. And you have properties that kind of age into undesirable obsolescence and are not really places those people want to live. And so a lot of times we're able to build to this middle market, whether that's through certain tax abatement programs and whatnot, or other types of programs. What you're able to do is you have a newer, nicer product that's competing at a price point with older properties that aren't nearly as desirable. And so the specific programs obviously vary by state, but this is really what we're trying to do is meet with the demand that's there for better product at these middle income price points.
Thanks, Jay. And I know that some of the two projects in Texas have this public-private partnership. There's something similar up the project in Washington. The project in California in Oceanside doesn't necessarily have this, but the rents that project has relative to the cost of going out and buying a home in that market, our project is much, much more affordable. And so probably, 18,000 definitions of workforce housing. The way we look at it is providing housing for folks that are in the workforce that's significantly higher quality and are, less expensive than other options. So yeah, that's a good question there. Jay, I know, some of the questions that we were all at NMHC, I guess it was in late January, and just, I think questions in the marketplace are like, okay, why invest now? Why develop now is now, tell me why we think, now. And I think to add on to that is, why develop? And you kind of mentioned this as, can we go out and acquire stuff for less than replacement costs? And so I think you've touched on a little bit of that, but maybe I think, you have a few more things in here that would, I think some data that would help answer those questions.
Yeah, I'll give you a couple other things. First of all, one thing that gets a lot of discussion nationally across the media and policy world and whatnot is that it's become significantly cheaper to rent than to buy. And so this chart is showing you here in 2024, it's about $1,600 more expensive for a first-time home buyer than an apartment renter in terms of monthly costs. So that includes your mortgage, the taxes, insurance, kind of your all-in monthly costs for a new buyer. Now, of course, if you bought 3-4 years ago and rates are cheaper, that doesn't apply. But for a new buyer, your costs can be a lot more expensive than your average apartment rents. And when you look at the forecast for where home prices and rates are expected to go, even if we see rent growth, reemerge, let's say even if it gets 4 or 5, 6%, you're not going to materially erase that discount to rent versus buy. And so that's a big piece of the story. I mentioned the drop off in supply. That's a big piece of the story. And there's another piece that doesn't get a lot of discussion. And that's the fact that we're seeing a lot of young adults who are now leaving the nest. And so this has been a big story kind of the other way around, a higher percentage of young adults living with mom and dad. That percentage has been dropping off over the last few years, about 800,000 young adults moving out from mom and dad's place, forming their own. And for most of these people, young adults leaving the nest, their first step is going to be an apartment. And I think that when you look at today's labor force, we have a lot of baby boomers who are entering retirement age. We're seeing high labor participation rates among low unemployment rates among those in the workforce. And so that's going to, the retirements among the baby boomer generation are going to continue to crunch the labor force to a degree that's going to favor younger adults entering the workforce and needing a place to live. And so, especially you think about kind of the workforce demographic of, folks who are public servants, teachers, police officers, firefighters, and civil servants, they're as they come into this market, they're going to need a place to live, and the middle income is going to this workforce housing is going to fit them very well. And then Payton, also, if I may, I want to plug just a couple other things. You talk about why to invest. I think it's important to look at this not just from a demand perspective, because I think all of us probably intuitively understand, hey, yeah, like we need more middle income housing. That seems obvious, right? But when you also look at this from an investment perspective, and even before, Payton, even before you and I got a chance to work together, I've always been, the last few years, been more and more drawn to this middle income space, because we realized that the data shows that it could be a win-win for investors, developers, as well as for renters and for communities. And so this is a paper that came from the Pension Real Estate Association. And the headline here, if you're not watching the screen, says, "Can investors afford to ignore affordability?" And it's talking about affordable housing more of a broad sense, not low-income affordable housing, but really in the middle income category as well. And what the article shows is that when you invest in middle income and lower housing, you tend to see more stability in terms of performance and high occupancy rates, particularly with higher quality investment grade housing, the type of stuff that JPI is building. And then they tend to, even in a volatile market, be more stable and outperform in those cycles. There's also a paper, real quickly, I'll talk about, from Mark Roberts at SMU and Jake Wegman from University of Texas. They talked about moderate income rental housing, which, again, there's a lot of words. If you're not familiar with the space, there's a lot of words for it: workforce housing, middle income housing, moderate income housing, attainable housing. It's all generally referring to the same thing. And so I just want to share one kind of highlight from their report, which showed that when you look at that orange dot in my screen, it highlights that point I made earlier from the previous paper as well, which is that we see a lower volatility in terms of standard deviation, so a lower risk, and even a slightly better performance than the overall apartment index as measured by NCREIF and their NPI here. So again, particularly when you look at when you get into this middle income and workforce housing category, the vintage can matter a lot because you have CapEx issues, other things like that. And so this newer construction at moderate rent levels, again, you get just that really, when it's done right, you get that better risk-adjusted return. And again, that's showing up in the data, not just from this cycle, but over a longer period of time. And so that's really the thing. There's the demand side, but also we have real data to show that from an investment standpoint, it outperforms as well. So again, it's a win-win. Renters benefit, but there's upside for investors as well.
Thanks, Jay. One of the questions came in, and it was really asking, it said lending starting to come back, and asking about, outlook on how the capital markets are evolving, and our views on will continue to evolve in 2025. And so maybe I'll hit on that a little bit, and then turn it over to Jill, you and Jay to add anything you'd like. As I said, we were out, and I'm sure some of the folks on the webinar were out at NMHC, big multifamily housing conference in Las Vegas at the end of January, and it was really interesting. I mean, it basically reinforced, I think, what we were already seeing and knew, is that on the real estate is a leveraged asset class, and debt. I remember when we were in late 2022, even getting construction loans was, more of a challenge, because banks were, they didn't, there was a lack of clarity on kind of what was happening. The debt markets are certainly coming back. We've seen spreads pretty significantly on the amount of, on just the the assets we're trying to get capitalized. And so I think that's the first to usually when you see that happening, then equity tends to follow. And I'd also say that on the equity side, there is a tremendous amount of dry powder that's been sitting on the sidelines, and kind of waiting to invest. Maybe and Jay, you touched on this, but there's I think a lot of folks said, oh, there's going to be distress. We want to we want to attack the distress. And there's been some distress out there, but I think most of the industry thinks that it's I think a lot of people thought it would be a lot more than it actually has been. because there's just a lot of rescue capital. And so, the conversations that we continue to have with, capital up and down the capital stack is multifamily is an asset class that is still, it's a very desired asset class. And I think there'll be, it's continuing to, certainly the whole capital markets went through a little bit of dislocation when interest rates started going up in 2022. But we feel like that's coming, it's coming back, and we're not projecting cap rates to get back down to 3% anytime soon. But we certainly feel like that there's every month and quarter that goes by, there's more capital that's leaning into this space. And so we feel like, again, that's why we feel like now is a great time to invest. But I don't know, Jill and Jay, if you want to add anything about onto that as far as, or disagree with me on your views as far as what the capital markets for multifamily will look like later this year.
I'll jump in, and so well said, Payton. I would just add, as we're at Pinnacle, we're a multi-asset fund, and so we have multiple funds that we've raised and deployed. And so what I would just say is, first of all, my thoughts on the capital markets is I think it's really a market of haves and have-nots, and I think that's become very acute. And while the cost of capital has increased, I also think that lenders and equity investors are being very discerning on which projects that they invest in. And maybe the spreads have come in. The cost of capital, I think, on the equity side hasn't necessarily decreased much, but I do think capital for both the lenders and equity is being very discerning. And so while I think it's really terrific and really belies the points that Payton is making, is the fact that JPI is able to get access to capital both on the equity and debt side to start the pipeline and fund the pipeline and move projects forward, and has a strong balance sheet. I think that says a lot about the firm, because I just have found that there are a lot of projects that cannot start, which is really, it's the point that we're making, which is, the reason that there's not a lot of supply coming in the market is it's hard to start projects. So I'd first, make the point is, haves and have-nots. On the workforce housing side, as it relates to capital, I think, speaking from the equity side, what's very attractive is that we're really looking at, if I think of like a curve, that we're really looking at the kind of bulk of the curve, where we're not focus on the one end, which is low-income housing, tax credit type projects. We're not at the upper end. We're really would be focused on a project that's catering to the bulk of where majority of the renters are. And so I classified that as, there's durability in that cash flow. And so these are folks where, you're, as you described, able to deliver a Class A experience at a reasonable price. And so I'd kind of make that comment on the capital market side. So I'll hand it over to Jay.
Yeah, well, thank you, Joel. Those are all good points. I won't be redundant, but I'll add a couple of things. And first of all, Payton mentioned NMHC, and our colleague Adrian Bain was on the development capital markets panel, and it was a really great panel. One of the things they talked about, which was very true, is that the banks, they were tightening things up a couple of years ago, part for regulatory reasons and part pressure, but also because we were at 50-year highs in construction, so they had a lot of exposure to construction loans. And what's happened is that as these projects have completed and refinanced to permanent debt, now these banks are underexposed to apartment construction. They're trying to recycle that capital back out, and so you've seen the market get, the debt banks coming back into the market again and competing with each other for these projects. And so the real challenge is more on the equity side, and that's been the issue for a lot of developers out there. And on that, as groups are raising equity, one of the things that Payton and Jill both mentioned is that there's been this anticipation among investors for distress. And just to build on Payton's point on that, a couple of things that have happened is that, number one, I think we overestimate how much stress will be in the market. In fact, I share this a lot, but there was a headline in the Wall Street Journal last summer, and it talked about the headline, something about how office loans are distressed, but a lot of apartment loans are too, or something like that. And you looked at it, and as you dig, it's an eye-catching article. And it mentions that MSCI, big data provider, estimates there's going to be about $80 billion of potential distress. And so you think, wow, that's a big number, $80 billion. I mean, I think to all of us, 80 billion is a lot of money. Well, there's $2.1 trillion of multifamily debt in the US. And so you're looking at like 3-4% of the market that's actually potentially distressed, not even actually distressed. So then you get drilled into that more, and you find out much of what is distressed is really older, less desirable product in less desirable submarkets. So even if you're in Dallas, it's the less desirable parts of Dallas. And these are, oftentimes projects that were built in the, early 80s and the 70s, if not earlier. And a lot of them were bought by groups that had a short-term investment strategy, value add, buy it, do a renovation program, sell it a couple, raise the rent, sell it a couple years later at a higher price. Well, that strategy worked until it didn't. And that's really where a lot of the stress is concentrated. So what a lot of capital is really wanting is more of the newer, nicer product. And again, like, you've seen some of the deals that have transacted. I mean, they continue to, we're seeing cap rates that have come back. They're not where they were, but they're getting back in toward the mid to high fours. And again, there's just not that many deals even out there. And so I think that's what's ultimately going to be pushing, more of the capital toward development. Nowhere near where we were previously, but I think that's what's helping make development a more attractive equation again.
Thanks, Jay, Jill. One of the other comments that Jill, I think you made, but certainly want to reinforce is on the JPI, what I quote unquote machine and how we operate. There, I think Oceanside, we spent 4 to 5 years on that, kind of entitlement process or anything before you get started. And even in Texas, where it's much, easier to develop than, California or Washington, the conversations and the, negotiations with our public, partners and even, getting things zoned, those things take a while. And so I think one of the things I definitely want to reinforce the workforce housing fund that we're talking to investors about is that these projects they're ready to go. And in Oceanside's case, we've actually already started with JPI Capital. So there's a lot of the risk and the timing issues, and development is there's risk in development, but I think we believe that we've taken out a lot of that risk on the timing, et cetera, just because JPI has been living just part of our normal business plan to get things teed up, and so certainly want to mention that as well. Let's see, maybe a couple more questions on one of the questions is they're concerned about building costs increasing over the next few years and making potential workforce housing projects not viable. I would answer that question to say, I don't think we've ever seen a time, even the GFC, I mean, maybe building costs came down slightly for a short amount of time, but it's actually one of our theses here at JPI that if you look at, construction, just the construction industry in general, the industry has become less efficient over time. So it costs more today, and it takes longer today to build a project than it did 20, 30 years ago. So we don't necessarily, we think building costs as an industry will continue to go up. And it does make things more difficult. That being said, part of our strategy here at JPI has become more, fully integrated, and we believe that the integration of our teams can help mitigate that risk. Certainly bulk buying, et cetera, some of the things that we do that some of the, maybe our smaller peers out there are not able to do can help mitigate that risk. Construction costs have gone up, over time, I think roughly 2x over the past 20 years, what, inflation has, but rents have also gone up. And another thing too is, and again, in some of these markets in Texas, where we have specific real estate tax abatements, the fact that we're able to work with our public partners and they recognize the value in bringing high quality housing that's new, where people actually want to live in. It's not that they're forced to live in it; they want to live in it. It's desirable. More than willing to work with us on the real estate taxes, which again takes a significant. Real estate taxes have been going up like this over the past few years, so that takes a significant amount of risk out of our pro forma. So we think building costs will continue to go up, but we believe that we can with our team and able to work with our public partners we can continue to make workforce housing, part of JPI's business plan for, for a long time.
If I could just add on to that, Payton, one of the things that we've heard from our limited partners and, in the family offices that we speak with is that, equity has options to invest in a multifamily or other strategies. And so people are really, these investors are really looking for an edge and, what about this firm has an edge over, over just maybe it's a merchant builder. And that's something maybe you could just touch on a little bit more. And one of the things that I think is impressive about JPI is the vertical integration. And so it's not, JPI isn't, and we've worked with, and I used to be at a merchant developer type firm. So you have the development, you have the general contracting, design, and how it integrates, and then the investment on top of that in technology and process. And with it, with the end goal being really confidence in the schedule and, in pricing. And then also, what I would also extend it to is, warranties and operations and, tightening that up. But maybe you could take a second to speak to that so that folks really understand what, the depth of JPI's team and how it's integrated.
Yeah, no, sure. So I talked about on our Monday morning pipeline meetings that, we'll go through 10 to 15 projects a week on average to kind of, look at those projects. And I'll tell you, how the fact that we're vertically integrated, how we look at the world differently than maybe some folks that aren't. So it was probably, late 2021 when real estate seemed like it was going to, the value was going to go up forever and cap rates, were declining. And our land chase team, again, we look at roughly 600 land sites a year in DFW, just the team here. Of course, we have teams out west. Our teams would be, underwriting stuff, say, okay, I'm making this up, but we have all of our assumptions. We know what it costs to build because we're building more than anyone else in the market. And we can afford to pay, $25,000 a door for this land. And we had some, new entrants come to the market, either new coming to the market or maybe folks that were here that weren't vertically integrated, and they may have, they have different assumptions, and they were, willing to, pay $40,000 a door. Like, we're scratching our head, like, how are they doing that? Because it just doesn't make sense. Now, we had a pulse on construction costs were going up, and so I think the fact that we're vertically integrated means that we, always have the best data on each part of the cycle, and it all works together. And so that's a big piece. And then you said schedule. I mean, schedule is very, very important to us. We've got on our job sites today, we've had some amazing talent come in from outside of the construction industry that's really helped us kind of look at what we're doing from a different lens. And today we have, I think JPI, we've invested approximately $10 million over the last few years to integrate more technology into what we're doing. And just a, small example of what we're doing but it's tangible. And I think it, hopefully, people can understand it is we have drones that fly our sites every week. We have our construction folks have cameras that, on their hard hat or their clothes that are taking video of what's happening in the space. And then that video gets uploaded at the end of the day. And then we have teams in either Brazil or India, both, that are looking at that video. And if there's any deviations, like, okay, this is what's supposed to be built versus this is what is actually built. If there's any deviations, then it flags our superintendent when he or she gets to the job site the next morning. They have on their iPad, hey, you need to go check, unit 226 because there's something off. And so being able to, find, issues, conflicts early in the process is key to helping mitigate risk and on the schedule as well. And so Kylie Harvey leads our design construction team. And he likes to say that, our industry, we don't have a finishing problem, we have a starting problem. And so JPI, we spend a significant amount of time with our integrated team, working to get get our projects set up right from the get-go, to try to, mitigate, kind of any any risk down the line. And again, we will have issues. We're not perfect, but that finding those issues early and solving those issues early with our integrated teams, I think is key. So I know we didn't get to all the questions. But we will follow up with the questions that we did not get to. And then I guess, maybe Jill, I'll turn it to you with, if you want to give any final thoughts, and I'll do the same for Jay, and then I'll wrap us up.
Yeah, so just really, I want to thank everyone who joined us today to offer your time. So thank you for joining us today. Really an honor to participate with Payton and Jay. And what I would say is I'm very excited about where we are in this market from a real estate investment and development perspective, with what we're looking at in terms of being undersupplied in this country by millions and millions of units, and really having an opportunity to help provide some solutions to that and at a rent that I think will really meet the market. And so that's something that we're just very excited at Pinnacle, and to partner with a great partner like JPI. So, and always enjoy reading and hearing Jay's insights. So thank you.
Thank you, Jill. Yeah, I'll just reemphasize something I mentioned earlier, which is, I truly believe in my heart, this is an opportunity with workforce housing to be impactful to communities and to moderate income renters, as well as to investors. This is, I think ideally you always want to have a win-win. And I think when you're able to build at these price points and be able to get your costs in the structure like what JPI is doing, it can really be a win-win where you're, again, impacting communities as well as your investors. So I'm personally very excited about that and honored to be part of the team doing it.
Yeah, well, we're honored to have you, Jay. As you know, I kind of teased you as we were, in the courting process, that JPI, could stand for J Parsons Inc. Because you're but yeah, we're super encouraged to have you on the team, and yeah, just really enjoy working with Jill and her partners at Pinnacle on this fund. And I just, end to say, just grateful for all the, there's a ton of things that people will be doing with their time, and so the fact that you invested the last hour with us is we're grateful for that. And our purpose here at JPI is, we say, to transform building, to enhance communities and improve lives. And kind of echo what Jay says, we truly do believe that investing in this workforce housing and developing, adding new supply, which supply is the only thing that's going to solve our affordable housing issue. Adding new supply with some of these creative structures will truly, enhance communities and improve the lives of the folks that live in communities, and, Lord willing, the folks that choose to invest with us. So we'll be getting back to the folks that ask questions that we could not get to. And then, if you have any other questions, please contact us. You have our contact information. And with that, I hope everyone has a great end of the week. Thank you.